Another day, another headline declaring that this will finally be the year that house prices crash. This is the same narrative that was predicted by experts in early 2020. But if we rewind all the way back to 2014, the same narrative was pushed. In almost 10 years since, none of these predictions have been anywhere close to coming true. But I hear you ask, surely this time it's different. Off the back of Kwarteng's ill-judged budget, which triggered dramatic interest rate rises during the worst cost of living crisis in decades, well, the answer is still not quite. I'm afraid the prediction of a UK property crash has been exaggerated, yet again. There's been a slight property market slowdown which has continued into 2023 as house prices fell for the fifth month in a row, according to Nationwide's latest house price index. House prices fell by 0.6% in January, leaving prices 3.2% lower than their peak in August. But when we look at these decreases in real terms, it's brought down the average cost of a home in January to $258,000, down from $262,000 in December, so only £4,000. I think most of the decreases have been fueled by the media who have startled the general public, because as you all know, negative news gets more clicks, leading to sellers lowering their expectations. I will admit that there is some truth to the predictions, but it's just overstated and will be short-lived. There are different definitions of a property crash, but generally it's seen as a minimum of between 30 to 50% fall. Between 2020 and 2022, house prices increased by a massive 21%, which is equivalent to around £60,000. The average house price across Britain fell by 18.2% during the 2008 market crash, which is almost £58,000. So if you look at it through this lens, then a crash is unlikely to materialise. So with this in mind, house prices would need to decrease by a whopping 60k on average just to undo the past 2 years of massive increases. And let's not act like house prices were anywhere near affordable in 2020, as they were still out of reach for most people. But I feel that this is most likely the best case scenario of a market correction, and here's why. It would be truly ignorant for me to ignore the rapid increase in the cost of living, from energy bills to basic necessities like food, with inflation hitting over 10% in combination with stagnated wages. Since December 2022, the average interest rate on a 2-year fixed mortgage has soared from 2.34% to 5.75%. This will add £377 a month or £4,524 a year to the cost of a £200,000 mortgage. About 3 million households are due to renew their mortgages in the coming financial year and will face that unavoidable squeeze. But we do underestimate how many people in the UK can stomach these types of increases and will make sacrifices in other areas. Most will be able to see this out and not be forced into selling their homes for a cut price. Back in the autumn of 2022, the then Chancellor Kwasi Kwarteng's September mini-budget proposals contained 50 billion of unfunded tax cuts. This shook the mortgage market, with rates rising to levels not seen since the 2008 financial crisis. The mortgage lenders reacted by pricing in higher future interest rates. Interest rates have already marginally reduced since reacting to current Chancellor Jeremy Hunt's reversal of most of Kwarteng's measures, with many lenders already revising their mortgage interest rates. In early January, the Financial Times reported that TSB had slashed its rates on its 5-year fixed mortgage rates from 6.29% to 4.99%, while Nationwide cut rates by 0.55 percentage points to 4.89%. The consensus from mortgage experts is that rates will see a continual decline throughout 2023, with some predicting that they will be back under 4% by 2024. So what does this mean for house prices? If interest rates don't stay at the high rates seen in autumn 2022, then affordability won't see a significant decrease as predicted, which means house prices won't crash, as we're already seeing demand for property rebound. Let's not forget that renting has become so much worse over the last 12 months. With more landlords being forced to sell their properties due to interest rate rises, we're going to see a rise in a number of surprise Section 21 evictions. And with landlords leaving the market, there will be an increase in competition for suitable properties, which will also inflate the rental market. We shouldn't ignore the fact that many landlords are under pressure from the rising interest rates, but will want to keep their property and will be cheeky enough to pass on all cost rises to tenants and force them to pay extra. With a shortage in rental properties, they will always find someone to rent at these inflated prices. When rental prices are just as expensive as mortgage costs, then many people will lower their expectations and buy in a less desirable property. With competition not reducing, this means people that can just about afford buying a house will likely flock to the cheapest houses, which could potentially have the opposite effect and drive up the prices of starter homes. Many people in these expensive rentals have had years of saving behind them, especially through lockdowns, so we're in a stronger position than most people realise. One thing has remained constant in the property market over the last decade, and that is supply is significantly lower than the demand, so prices will remain high as there are an insufficient number of new properties coming onto the market. New figures that reveal the true scale of the housing supply crisis for the first time have been published by the National Housing Federation. The research, conducted by Heriot-Watt University, shows that England's total housing needs backlog has reached 4 million homes. To both meet this backlog and provide for future demand, the country needs to build 340,000 homes per year until 2031. This is higher than the current estimates, including the government's target of 300,000 homes annually, and the current trend where 243,000 new homes were built in the year ending June 2022. With demand still fierce, people will still keep trying to get onto the ladder, so even if interest rates make it tougher, they will just find areas of their life to cut spending. To make it worse, companies building houses are starting to be affected by the economic troubles in general, so they can't hit their targets. This means less houses for an ever-increasing population. Whether we like it or not, the government has vested interest in keeping house prices high and preventing a crash, and several times we've seen them step in with schemes and measures to protect the market. Many members of government have their own property investments or have active donors who have huge property portfolios. Most regular homeowners in the UK have a significant amount of their overall net worth tied into their property, so any market crash could have catastrophic effects on the whole country. One of the measures that has stayed in place since the autumn 2022 budget announcement is the stamp duty relief, which is also relaxed for buyers who aren't buying their first property. This means that buyers will pay no stamp duty on the first 250k of a property, which is increased from 125k. Measures like this mean that buyers can afford to spend more on their property, and I fully expect that if the market starts to move towards a real crash, then the government would provide more assistance to the market. Winter has traditionally been a difficult time of year to sell a property, as people are normally not willing to move at this busy time of the year with the Christmas break in between. Properties tend to sit on the market longer, which makes buyers think that there's something wrong with the property, which creates a perpetual cycle which leads to sellers reducing the price. Couple this with the budget announcements in the autumn and this is a recipe for disaster. Rightmove data suggests that March is the best month to start selling a house, and houses put on the market in March took the fewest days of 57 to go under offer. This is a lot to do with the weather, where the days are getting longer and bank holidays provide more free time to plan viewings. Gardens and homes feel lighter and brighter in the bloom, so properties look more enticing, so sell quicker. I'd expect this yearly trend to continue, which will combat the current small property market decreases that we've seen in the year to date. One key thing that we've seen worsen in the last 2 years, and that's wealth inequality in the UK between those that have and those that don't. 5.2 million new millionaires were created worldwide from this period of time. So despite huge parts of the population struggling, there has been a subsection of society who have been thriving. The reason I mention the worldwide numbers here is key because the UK property market has long been attractive to overseas buyers. These new millionaires will often be cash buyers, so they won't be affected by any interest rate rises. So they will have no problem buying at the asking prices and won't be waiting for a market crash. These high net worth people won't be forced into selling their existing properties as they're likely to be mortgage free, so they can ride out this interest rate rise. Any potential interest rate rises could cause even more wealth inequality, as the wealthy will continue to hoard and accumulate even greater levels of property. This will in fact have a worsening impact on property prices as more properties move from the home buyer market into the rental market. There's no doubt there will be parts of the population who will struggle with the interest rate rise. However, many can combat this by locking into a new, longer fixed-term rate by paying an early exit payment so they can move to a new deal. There was an initial rush to do this in the autumn. However, many homeowners are already seeing interest rates begin to relax, so the effects may not be as dramatic as they first feared. Some existing homeowners have already decided to move to a variable rate when their fixed deal ends this year, as they expect interest rates to ease throughout the year. Interest rates will never fall back to pre-2022 levels, but there's hope within the market that they will reduce back to under 4% sooner rather than later. Any falls in the value of property is only realised when it's time to sell, and many homeowners can afford to ride out these interest rate rises for the short term and wait for them to eventually settle. In the UK, 36% of homes in the UK are owned outright without a mortgage, so this is a huge subset of people who won't be forced to sell their home, which will minimise the likelihood of the market crashing. This is a vast pool of people that have no requirement for borrowing. For there to be a crash, it needs a huge number of people to default on their home loans, which I don't believe will be the case. It seems that banks have learned from the previous housing crash that it's best to keep people in their homes if they're struggling to pay and keeping their high mortgage, rather than repossessing something that's worth a lot less. Housing prices did drop in 2008, but repossessions weren't like the recession in the 1990s, and I expect the same to happen this time around, especially as banks might expect this to be a relatively short-term problem that will pass sooner rather than later. As always, this extremely affects first-time buyers the most, and interest rate rises will more than likely make it harder for people to join the property ladder. So do I expect to see a decrease in property prices? Yes, but no more than taking us back to the 2020 prices at the absolute maximum.